This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
I'm Gord Long. I have with me this morning Mish Shedlock of Sitka Pacific Capital and the newly named MISH'S.com. Welcome, Mish.
It's a pleasure to be back on the show. Yeah, it's Mish Talk here now. I've been working on that for a long time, but my new blog is a website, actually, no longer a blog. I've got a website out there, and I'm pleased with it so far. What matters is actually the readers seem about 80% of them like the move.
That's a nice format. I'll echo that too. I liked your other format too. This one just a little bit different, and it looks like it'll make it easier for you to blog and post on it.
Well, actually, it is easier to blog. WordPress has a lot more controls. Actually, a lot of them are nearly identical, but I actually have some extra controls. And even though the controls are nearly the same, the way they work in WordPress is a lot easier for me to work with. So on a personal end, that's what I'm happy about. And you can't please everybody. So, but the overwhelming majority of people like the new format. So I'm happy.
And it's MISH'S.com, all one word, right?
That's it.
Just so everybody's got it there. Mish, a lot of things have happened, and I want to jump right in here because we got a lot of things I want to cover if we could. FOMC meeting earlier this week. What's new? What happened? What did we learn from it?
Well, we learned that we're not going to get 4 hikes this year. I think some of us knew that anyway, right? Actually, you don't know everything, but I would have put the odds well over 90% that there wouldn't be 4 hikes this year. In fact, I don't think there's going to be any. If they get in 2 more hikes, then I'm probably wrong about where the economy is. So we'll see. But they lowered their expectations from 4 to 2. The market lowered the expectations from 2 down to 4. And the market expectations actually about a month ago were for 0 hikes when the stock market was in a big tank. Now they moved up to 2. They moved to about 2 ahead of the announcement, and they moved back down to 1 right now. So it's 1 versus 2. At least they're in the ballpark here, Gordon, in terms of agreement.
Where is the economy? You said where the economy is. Where is the economy? Do you see a recession possibility here in front of us in the United States?
I still think recession. It's changed my mind about the U.S. not being in recession here. We had a couple of weak reports. We had a good report out today, Empire State and 2 days ago, and Philly Fed manufacturing regions bounced from negative territory after being there for about 7 months back into positive territory. I wrote on my blog today that I think that a bounce had to happen at some time. New orders aren't going to fall forever. So I think all we've seen is a little bit of a snapback. Whether or not this has to do with any kind of seasonality, I don't know. But the more important thing is industrial production is back negative again. Consumer spending was not only negative, they dramatically revised last month lower from positive territory all the way, deep into about 0.4 of a point contraction. I think that was the real story. That might have spooked the Fed. What I actually think spooked the Fed, though, is CEO reports. They've got these round table of CEO hiring projections. And in December, a net of the CEOs just barely saw an increase in job hiring this year. Now, and these are large corporation CEOs, It's small businesses that drive the economy, but it's large businesses where most of the employees are, and large 10% of large businesses expect to reduce headcount this year now. I think that might have spooked the Fed. I haven't seen anyone else talk about it but me.
You're talking about 38% of the companies saying they think they're going to reduce headcount next year.
Yeah,
I think I saw that was in one of your posts.
Exactly. 38% said they would reduce. 29% said they would increase. The rest of them said they would stay the same. Now, this is a diffusion index. It doesn't say by how much. It just says they expect to reduce a headcount. So a company reducing a headcount by 500, it counts the same as a company expecting to reduce a headcount by 2. But I don't think they would have said 2. A small business might have said 2. But, these are large CEOs. I think they would have said no net change if we're talking about small numbers like that. So I think there's going to be a significant change. And then they call this report mixed, Gordon, which I kind of had to laugh at, because although their hiring expectations were negative, the reason why they said it was mixed was that their views of the economy rose. But I did a plot of this and showed that CEOs' views of the economy are more lagging than GDP. It's amazing. GDP is an extremely lagging indicator. And guess what? Corporate views of the world lags even GDP. And of course, jobs are a lagging indicator too. And I had an interesting chart in that came from the same report, where jobs and CEOs, both lagging. I put the two of the charts together, and they were exactly coincident, lagging together, until about a year and a half ago. And I said, what happened then? And the answer was Obamacare, which changed the rules of some things, such as corporations with more than 50 full-time employees had to offer benefits. So guess what happened in response to that? Corporations that were like right around 50 employees, full-time employees, didn't hire any more full-time employees. And in fact, the Obamacare changed the definition of what a full-time employee was, down from 32 and a half hours down to 30, and corporations desperately did not want to go over this 30 threshold for Obamacare. So they cut everybody's hours down to 25. All the people's hours who were cut down to 25 went out there and picked up a second part-time job, and that's what skewed the job numbers. And that's why the CEO's expectations of hiring no longer matched. Obamacare trumped it because of all the part-time jobs we created. No one's reported on that. Well, people have talked about that before, but not in light of CEO plans. So that was some new analysis that came out just the other day ago, and I think I was first to post on that.
I think you're really right on that and very close. I might use a little different terminology. CEOs, yes, in their statements, but any company under 50, which is that qualification. This has been a bartender and waiter recovery. That's where all the growth and jobs have been, in that element. And so it's really, I won't use the word CEOs, owners of bars and restaurants and large fast food that employ 60, 70 people easily when you're running two shifts, 3 shifts. And they have cut back the hours down to the 30 so that they didn't have to pay the benefits. And now that's where I personally have witnessed it right across the board up here in New England. It's that segment. And if you look at small business sentiment, has been plummeting, and expectations have been plummeting. Now they're CEOs, but they're really small enterprises. And that's where the hiring is, as you correctly point out.
I think we've kind of seen the end of the Obamacare lift here. And the reason is Walmart is announced a bunch of store closings this year. The large corporations just come out and reduce not only reduce their hiring plans, they're actually going to go to cutbacks here. They expect a reduction in headcount. And we don't need any more Pizza Huts. We don't need any more McDonald's. We don't need any more Chipotles. So, all of that has been the real driver of job growth here. So I think that's coming to an end. The increase in minimum wage, which everyone says doesn't hurt, logically speaking, you and I know that it does. They say it doesn't hurt. They say, and the reason why they give Gordon is that they look, jobs have gone up. Well, jobs went up because of Obamacare. Jobs went up just because of population growth. Jobs went up because of store expansion. So the question is not, none of this had anything to do with the increase in minimum wage. What we can say is the increase in minimum wage, without that, hiring probably would have gone up more. So that's how I look at things.
I don't mean to quote Trump, and I'm not being a proponent of Donald Trump here, but he did make an observation when he was looking at thousands of people in front of him, and he said, if employment was really 4.6 or 5%, do you really think we'd have 30,000 people here today? If it was, he says, this looks like more like 35% unemployment rate to me, and he went crazy. Of course, they always seem to go crazy when he makes insultive kind of comments, but it is a really valid point. We have a tremendous amount of hostility because of losing their jobs, not making enough money to live on, or fear of losing their jobs. Tenuous situation that I witnessed. I don't know if you're seeing the same thing or feeling the same.
That was a very accurate observation. Certainly, the unemployment rate's not 35% here. 22
or 23, if you look at those. The numbers correctly.
I don't know what I would call it here. It's really a very difficult number to come up with unless you define it in a way that makes it easy. The way to make it easy would be if you don't have a job, you're unemployed. So but that is the other part of Trump's phenomenon. And that's where Steen Jacobson, CIO of Saxo Bank, came out with a report, and I wrote him back, and I told him I thought, Steen, this is really excellent analysis, and he wrote back to me, he said, Mish, you're too kind. I don't think I'm too kind. I think I'm a fairly objective, or at least I try and be. Everyone has biases. But I thought that was a good summation of the events. He's said things in a different way that explain some of the things that I said. He called it a decline in the falling apart of the social contract. So that's it. I described it earlier as people are, angry about wars. They're fed up. They're fed up with wars. They're angry about falling real wages. I think that really is what explains, those things explain the rise of Trump. Steen called it the breakdown of the social contract. And so, these people were all told, and just look at students, they were told, go out and get an education. No matter how much you spend, you'll get a job and it'll cover your college. Guess what? There's over $1 trillion in student loan debt that can't possibly be paid back because these people are working part-time or minimum wage jobs. Is the answer to raise minimum wages? Well, that's what some people think, but not if it reduces the amount of hiring. And, one of the things central banks did, and actually took credit for, that everyone seems to be forgetting about here, is Bernanke came flat out and took credit for the rise in the stock market, as if there was going to be some sort of trickle-down theory here, borrowing an old Reagan term, that would cause all this hiring, that would cause spending, whatever. It didn't. So everything that the Fed did fed into assets that not many people have. or the top 10, top 20% of the people had, but it mainly benefited the top 2%, top 1%, top 0.5%. Those are the people that made out the best with the Fed policies, and by trying to drive up the cost of things, they're finally succeeding now. I don't think they're going to be happy with the result. Gasoline prices going back up, the Fed's cheering. Medical costs going up, the Fed's cheering. Obamacare is money out of people's pockets. It's money they're not going to spend on a lawn tractor. It's money that they spend on rents is going to go to the rentiers. That's not going to go to the bulk of the people who are struggling to get by. It's not going to help anyone on fixed income when their rent goes up and the CPI miraculously says, well, we're at 0.5% or 1% or whatever the hell it says. Obamacare and rent is eating up far more of that. So there's very little to cheer about here in the prices that actually are starting to go back up. And I don't think there's going to be a lot to cheer about here when oil prices go back up too. So, how are consumers going to react to that remains to be seen. But certainly if businesses start cutting back and real wages sink further, which is what they're going to do if Bernanke gets his, if Janet Yellen, gets what she and Bernanke want, and the central banks get what they want. Meanwhile, crazier and crazier ideas are coming out. In Japan, the IMF proposed, this actually came out in December, the IMF, but I just saw it the other day. It came out in a report. IMF was this guy's name, Oliver Blanchard. Is that it? Former top dog at the IMF came out and said, what we need is wage and price controls, but he wanted them in reverse. So he wanted to force prices up and force wages up. The last time we tried these, they tried to put a lid on everything to force prices down, force wages down. He wants a floor, and he wants that floor to keep coming up. It's crazy. These people have not thought through the ramifications of such absurd meddling in the markets. And those on fixed income are going to get burnt. And he was proposing this for Japan. How many retired people do we have here? Do we have in Japan who are not exactly going to whose wage hikes, if they come, wouldn't even benefit them, but whose price hikes is going to take money out of their pocket when all they've got is what, Japanese bonds losing money because the yen's sinking. So people need to think through the ramifications. All these ideas that sound pretty are just more meddling in the markets, and it never works. It never works.
Draghi made some, ECB's leader made some major announcements here last Thursday. Comments on those changes or policy initiatives?
Mario Draghi came out, and at first he disappointed the markets. First he elated the markets. The euro sunk, which is what he wanted it to do, and the markets rose. And then all of a sudden we had a big reversal. The things went switched directions. So what happened was, in a conference call, Draghi said, "Well, this is the end of all the cuts he can do." The market didn't seem to like that, and the euro not only reversed its losses, but added a couple percent the other direction. So we're talking about a pretty big swing when we're discussing here the euro in terms of the currency movement. And I analyzed this, and I said, everyone, the analysts were all upset. I saw on Bloomberg, they interviewed a whole bunch of economists, and they said, well, that was a really dumb thing to say, blah, 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 blah. And they were wondering why he would have said that. And I think it's because he had to. Every time the ECB knocks rates further into negative territory, he's actually hurting bank profits. And the reason is, all of the mortgages in Europe that are tied to something called Euribor, which is essentially the rate at which banks are willing to lend funds to each other overnight. Okay, and the reason why, and that's now sitting at negative 0.4%, thanks to Bernanke slashing. Excuse me, thanks to ECB's chairman Mario Draghi slashing interest rates to negative 0.4%. So negative 0.5 now. So here we are. If he lowers them any further, there's millions and millions and millions of mortgages in Spain, in Italy, in Portugal that are all tied to the Euribor rate. And normally it's Euribor plus 1. So, but if he cut the rate to greater than negative 1%, then banks would have to pay people for the mortgages. People would get money back on their mortgages, cash back. So obviously that would destroy bank profits. So he might have a tiny little bit of cushion here because most of them are tied to an annual Euribor rate, which is still about negative 0.1. But some people do have it tied to monthly rates, which now negative 0.4. And the further he cuts that, the more he's directly hurting bank profits. So that's why he said he reached the end, and people didn't figure out why, and that's the answer, Gordon. So instead, there's always some wizardry that they can do, right? So instead, he's going to buy corporate bonds and try and drive down corporate bond rates. Great, that's going to be beneficial to corporations. Going to cause them to hire anymore? I don't think so. Why is it?
The policies just seem to get stranger and stranger, but they're losing credibility in Japan, certainly in Europe with the ECB. I think the Fed, it's also maybe the Bank of England's the only one that has some level of confidence, but they're running out of we'll still see NERP. We probably may see helicopter money, if I can use that, OMF or that sort of thing. There's still some more tricks here, but I really sense a lack of confidence that's building in a lot of the institutions. Are you sensing that, or do you feel that?
Well, true helicopter money would be the Fed giving money away. They can't do that. National governments can. So where are we going to see that? Actually, if you look at things like food stamps, that's giving money away. So they can go that route. But we've also seen these proposals for a guaranteed living wage without working.
Guaranteed income. Switzerland, they're beginning to talk about it in Canada, a number of the countries, to more and more talk. Universal income.
Canada tried it once, and they're talking about doing it again. And they claim that it worked in Canada. I can't remember exactly when they did. It actually didn't work. The reason how it worked is they did this for one town, okay, and certainly it helped all the people in that town, Gordon. Okay, no question about it. But who was at the expense of? They had to tax everybody else in the Canadian province and give the money to the recipients in one town. So how is this going to work nationally? Where's the money going to come from, Gordon?
It's going to be the lottery of which town wins, or which town.
Yes. So that's how they claimed it worked. I don't know if you knew that or not, but that's how it worked.
Yes, I did. I still have a Canadian passport for what it's worth, Mish.
Oh my God! When you hightailing it out of there, people ask me that all the time in Illinois. Let me put it this way: I've got my plans.
Well, Justin Trudeau did say that everybody is welcome back to Canada if they're not happy with the next election, but we'll just leave it at that. Mish, this lack of confidence that I was alluding to, that I'm sensing, I see gold is now broken out, or at least it appears to have broken some very major overhead resistance priced in U.S. dollars going back a couple of years now in terms of this falling trend. Comments? Is gold telling us anything?
Well, I think it is. I think it's we're seeing just the very beginning, just the tip of the iceberg here in terms of realization that central banks no longer have everything under control like everyone thought. And I don't know whether gold will be the next bubble, and I'm certainly not going to come out with any price targets like 6,000. I think when people put these kinds of price targets on there, they end up just actually looking ridiculous. And, you know, when silver hit 40, everyone said next stop 200. Well, guess what? The next stop was 13 and change. So I don't know how high they get, but I do think we're seeing a beginning of a return to things that were way out of favor. Gold and precious metals. So, and I think we're just in the beginning of that run without putting any price targets on it. I think we're closer to the beginning than the end. And it's interesting when this started happening too, because Goldman Sachs just came out and right before gold took off and reiterated, you know, time to dump gold and, you know, put its price target of $900 on it or whatever. And some other corporations, institutions like that did the same thing too. They downgraded gold. Now they're slowly starting to upgrade it. Money is pouring into the ETFs. If we view gold as a currency, which I like to do, currency trends tend to be pretty sticky for a long time. So think of the U.S. dollar that rose from below 70 or right around 70, 72 maybe, and the last rise up all the way up to 100. It fooled me. I thought that it would get to 90 and the gold and the dollar would stay kind of in that range. It exploded way to the top of that. Now people are expecting more and more and more on the basis of these Fed hikes that you and I don't think are coming. So that's another message here in the dollar here, that these hikes aren't coming, and maybe the dollar had some room to rise if the ECB was going to go further down the negative rabbit hole, but they didn't. The ECB came out, and so now if the U.S. economy weakens at all, you know, the dollar has a lot further to fall. Now, given that Japan is likely to do some more crazy things, and I think Europe is likely to do some more crazy things, so we're talking about relative craziness, you know, versus each other. But as soon as if and when the Fed comes by and says, you know what, or the U.S. goes into recession, I think the dollar is going to really see a big decline. It ain't going to fall all the way to 72, not in any hurry. But the slower it falls, the better that's going to be for gold, because gold can rise every step of the way, you know, with the sinking dollar. And I think that's what we're going to see. And gold in other currencies, gold in the rand, gold in the yen, all look pretty reasonable, you know, right now. It was only gold in U.S. dollar terms that really took a smashing, and I think that's what we're going to unwind.
Yeah, exactly. A lot of people would tell you the same thing, that, you know, in actual fact, gold probably bottomed in 2014 if you start looking at a broad range of various currencies, not the U.S. dollar, not the Canadian dollar. And we lose track of that when we're focused on it in regards to the U.S. dollar. Mish, just as we close here, of all your posts this month, because I haven't talked to you in a while, anything that we haven't talked about that's a favorite that you wrote about?
I really like the one from Steen. I like the one that I did, that we did talk about here, which is CEO hiring plans. And I think that's key. I'm working on one right now that's going to be coming out, and it's a look at inventories. Inventory numbers came out the other day. They were pretty horrific. And what was weird was just a month ago, Bloomberg was calling them good. And I said, what, are you out of your mind? And now they look even worse. So this is another thing that has to do, you know, with this expectation today that because the Philly Fed rose and the Empire State rose, and I commented on my blog, I said, well, I think you're forgetting about something, and it's something they're forgetting about is inventories, and I'm getting ready to write about that. But we are above recession levels looking back at inventory to sales ratios here. So, it's just another viewpoint here. And of course, GDP is always very, very lagging indicator. And I know more revisions actually are coming in July of this year, and they are going to be pretty negative for 2015. So we're going to see a markdown in GDP in 2015. So, all this, happy talk is slowly going to morph into something else. Where the stock market goes, I don't know. And that, I took a lot of flack. In December, everyone was coming out predicting collapses. Stockman was one of them. I had several people email me. One person said he absolutely knew, rock positive, that the stock market was going to sink, starting in December and drop 40% or something. Guess what? It recovered all of those losses today. The Dow is green for the year. So and people need to be careful about their convictions here. And I don't know what the stock market's going to do. I just know that it's overvalued. My favorite scenario on the stock market, if I get in one more idea, is not another big crash. We're not going to have a housing crash like we had in 2007-8. We're not going to have corporations struggling to borrow money again, which is actually the big factor in the stock market collapse in 2008, 2009. Corporations were priced as if they could never tap the borrowing markets again. I don't think we're going to see those two things. So if not, that might rule out another crash that everyone seems to be expecting. However, we can just do a slow Japanese-style decline where the stock market goes down 5 or 10% this year, 5 or 10% next year, 10% the next year, and 5 or 10% after that. Guess what? The stock market is now down 35 or 40% in 4 years, but there was no crash associated with it. I think that is the most painful scenario, because a crash, people can just plow back in at the bottom and drive prices back up like they did. That doesn't happen on a slow decline, and that's how I'm leaning for. I may not be right, but that's how I sense things are going to play out from here on, Gordon.
Appreciate your frankness, Mish. You're usually pretty close on calling these, so we'll of course we're going to be back talking about it each month. So Mish, thanks for the time. I really appreciate it, and we'll talk again next month.
Pleasure to be back on. My little tan here, I was in Death Valley for 15 days, had a great time, phenomenal wildflower bloom, and I'm actually going to be starting a photography blog too, so we'll talk about that next time.
Okay, talk to you. Thanks. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.